So you're thinking of investing. You've got maybe a little bit of extra money. You're thinking of, should I invest it in stocks, or should I buy property, or should I go into crypto? What should I do with this money? How should I invest it? My name is Woody, and I've been investing for the last 20 years. I've had some highs and some lows. I've made some good decisions and some not so good decisions. And I just want to share with you what I know now that I wish I knew when I started way back when I was 18. And there are 5 key items in this video that I want to share with you. We're going to work our way backwards from number 5, but stay with me because number 1 is probably not one that you're expecting, and I think it is the most valuable piece of advice that I could offer you. Number 5, investing is necessary. Not to get rich quick, but to avoid losing money to inflation. And the key to understanding inflation is basically what happens to your money if you just sit on it, don't put it anywhere, don't do anything with it. Like, let's say you have $10,000 and you just put it under your mattress in cash. What happens to that money over time? Well, it actually goes down in value because every single year, inflation causes the price of everything to go up about 2 to 3%. And that amount varies from year to year. Sometimes it's a little less. Lately, it's been a little higher. It can be overwhelming, and that compounds, that inflation compounds just like interest or investments can compound. It's just compounding against you. Now, the first thing that you can do is make sure your money is in a high yield savings account, if nothing else. And you get that money and it goes into your checking account, just move it into a savings account. You can always move it back when you need it, but getting it into a high yield savings account is going to at least help you combat some of that inflation, that 2 to 3% that we're losing every year to inflation. You can be getting that back in the form of a high yield savings account. There are a lot of great savings accounts out there with different banks. I don't want to recommend one over the other. Personally, I've been a fan of Capital One, but use whoever you want. I heard Marcus by Goldman Sachs is good. I've heard great things about Vanguard. I've heard great things about Charles Schwab. But you want to get something that gives you at least that 2 to 3% and is easy to use. Now, a high yield or high interest savings account can protect our money from getting lost to that inflation, but we can do better than that. And the way we do better than that is by investing. Now, there are a lot of ways to invest, but first let's define what an investment is. I define investing as acquiring assets that give you returns over time. And there are a lot of ways to do that. You can do that by buying into the stock market. You can do that by buying into real estate. You can do that in a number of ways. And we're going to cover a few of them in this video, but that's how I define investing. It is acquiring assets that give you returns over time. Now, what makes a good investment versus a bad investment? What makes something high risk versus low risk? Now, we'll get to that, but first let's get to number 4, which is there are many ways to invest, but the boring ways are often the best. Now, I've heard this time and time again over my life. I've heard it from my parents. I've heard it from mentors. I've heard it from all kinds of people, and I've read it in books. It really stood out to me in books like The Psychology of Money by Morgan Housel. Great book. I'll link that in the description below this video. If you haven't checked it out, definitely worth a read. But when it comes to investing, you've got to play the long game. And what that means is doing the same thing and the right thing consistently for a long period of time. Now, when you think about investing in the stock market, it's kind of the antithesis of that if we're talking about buying individual stocks. Sure, if we could go back in time and we could invest in Tesla or Apple or Nvidia or any of those, you'd be rich. But nobody has a time machine. Nobody can predict the future. All you can do is educate yourself, come up with a reasonable strategy, and stick to it over a long period of time. Now, there are 3 types of boring investment accounts that I want to talk about right now. That's going to be a 401k, a Roth IRA, and an HSA or health savings account. I know that last one seems odd, but we'll explain that in just a second. So all of these have benefits, and the fact that they are tax deferred in different ways is a huge advantage for what can happen with your money while growing in these accounts. Let's start with a 401k. This is something that is typically sponsored by your employer. It is similar to a regular IRA, not a Roth, but it's through your employer, and they typically have a match. So if you work for a company that offers a 401k program and they match a percentage of what you contribute to it, you have to do that. You have to contribute at least the minimum that you need to get the match. It's free money. You're just leaving money on the table if you don't do this. The other benefit of that is that the money is not taxed. So it actually lowers your taxable income when you contribute to a 401k. Let's say you make a salary of $60,000 a year, and normally the full amount of that would be taxed. But your employer offers a 401k program, and they're gonna match $3,000 of that, whatever that percentage works out to. So if you contribute $3,000 a year to your 401k, they contribute $3,000 a year to your 401k. This is typically done in the form of a percentage. So let's say 3,000 into 60,000 is actually 5%. So that's a pretty solid match. So 5%, if you contribute 5% of your income, they're gonna give you another 5% and just put it in the account. That's awesome. But you're also subtracting $3,000 from your annual income in terms of what you can be taxed on. So instead of being taxed on $60,000, you're now only taxed on $57,000. Might not seem like a huge difference, but you can contribute more than whatever your employer matches. Their match will just stop at whatever their limit is. And you could lower your tax burden even further, especially if you're trying to play catch up with your savings. But years and years and years later, when you retire and you're allowed to start taking disbursements from this account without any kind of penalties, that money will be taxed at whatever your taxable income rate is at that time. So you will have to pay taxes on it eventually, but you get to grow it in this account tax-free that whole time and save on what you pay in taxes earlier in your life, which is a plus. Now, the Roth IRA does things a little bit differently. With a Roth IRA, you put money into the account after you've already paid taxes on that money. So the benefit here is that when you go to take money out later in retirement, you actually don't pay taxes on any of those disbursements. Now, the 401k and the Roth IRA both have annual contribution limits. You should look those up at irs.gov to get whatever the current numbers are. Those things can change over time, but generally speaking, you can do a lot just trying to max out your contributions in both of these accounts before you even look into other investment opportunities. Now, I also wanted to mention an HSA, which is a health savings account, because if you are on a high deductible insurance plan, you may be eligible for an HSA. And I have had employers in the past that offered a contribution, free money from the employer, so long as I was contributing something to the HSA. And in my experience, it was $500 every 3 months, so $2,000 a year that they gave me in free money that I got to hold on to, as long as I was contributing a minimum amount, and I think that was $100 a month or less. Now, an HSA is different than an FSA or a flex savings account. All of these are for health expenses, but they work in kind of different ways. How the HSA is different is it's not a use it or lose it account. With the FSA, you have this money, and if you don't spend it by the end of the year, it's gone. You just give it up. But with an HSA, that's your money. You get to keep it, and you get to keep whatever contributions the employer may have given you as well. Now, here are two cool things you may not have known about an HSA. You can take those funds that are in the HSA and you can invest them just like you would invest the funds that are in any of the other accounts we already talked about. You can put them into index funds, mutual funds, target date funds, and I'm going to explain those three things in just a minute. But you can invest it and you can watch that money grow just like you watch the money in your other accounts grow over time. The second thing about an HSA is that it is triple tax protected. What does that mean? It means you don't pay taxes on the money that you put into it. You don't pay taxes on the growth of that money over time. And when you withdraw that money for qualifying medical expenses, you don't pay taxes on it then either. It is just cash going straight into your account or straight to the medical expense. Now, at this point, you might be asking, hold up, why should I care if this is only for medical expenses? Well, let me tell you something. I don't know how old you are. When you get older, you need a lot more in terms of medical care. You need a lot more in terms of medical expenses. There are a lot more doctor's visits the older you get. And if you stay in good health, you'll have fewer of those things. But still, there are things that you're gonna do, things that you're gonna spend money on for your health. And all of those things can come out of this account that has been growing completely tax deferred. And it's just another way that you can save money, because if you're paying for these things out of that bank account, you're not paying for it out of your checking account, and then you have more money to do stuff that you want to do. So if you are eligible for an HSA, I highly recommend looking into it. And if you want more information, I can do a totally separate video on just this subject. If you're interested in that, please leave a comment below this video and let me know. And if I see a few of those, I will definitely go ahead and make that video that goes more in depth on how to get the most benefit out of an HSA. Now, with any of these accounts, whether that be the 401k or the Roth IRA or the HSA, steady contributions are the key to success here. All right, you want to be contributing the same amount all the time. And if you need to make a change to what that amount is because of circumstances in life, try to keep that change in place for a long period of time until you're ready to level it up and keep that in place for a long time. So if you can only afford to put $50 into your 401k out of every paycheck, that's fine, but just do it. Just start putting it in as long as you can commit to doing that $50 every single month. And I promise you, when it comes out of your paycheck, before you even see it, it's like you don't even know that it's there. You're paying yourself first, and that's important. There are programs that also will increase your contributions by X percentage, by 1%, 2%, whatever, per year, just automatically so that you don't have to think about it. It just happens. It's kind of a set it and forget it. I know Fidelity offers this, and I'm sure that other 401k and Roth IRA management accounts do that as well. Now, another consideration with these investments is where do you put the money? Because you can't just put it in the account. It kind of sits in a cash balance in the account, and it might grow a little bit, but it's not really in the market until you set it up to be in the market. I've had friends that had their money sitting for years. They were like putting money in their 401k and they were getting their match from their employer, and that amount was increasing every year, but only by the amounts they were contributing and the employer was contributing. And there was like no market growth. And they were like, why? You know, like, why does the market suck? I heard the market's doing better than this. And it was because they never put that money into anything. You actually have to move it into a fund of some sort. And that might be a mutual fund, that might be an index fund, or that might be a target date fund. I'm not going to get into all of the differences of all of those, but I'm just going to say right now, target date funds are the jam. That is what you want. It sounds crazy because you're going to look at these and you're going to try to understand the charts when you're comparing them, but some of them are going to look like they are giving you way higher returns, you know, when you look at like performance over the last 1 year, 3 years, 5 years, 10 years, and you might see some that are returning 12 or 18%. You got to look at more than just what that return is. You got to look at the expense ratio, and you want a really low expense ratio. Some of these funds, like mutual funds, are going to be more actively managed, and so they have a higher expense ratio, and you just want to steer clear of anything that has too high of an expense ratio. If you invest in target date funds, that's basically like you're picking a day, you're picking a year in the future when you think you're going to retire. So year 2050, the year 2055, the year 2060, just as a few examples. And the fund is basically catered to balancing risk tolerance with that end target date in mind. And these funds tend to have the lowest expense ratios of all of the options that are available to you. No joke, I have one with Fidelity that is a 0% expense ratio. There are some limitations that come with that, but it is a target date fund for a certain year, and it's going to be riskier now, and that risk is going to taper down, and they're going to go into like safer investments, more bonds and things like that. They automatically rebalance it for me, so I don't have to think about it. It doesn't cost anything in terms of fees, or very little. And the best part is I don't have to worry about any of it. I just make sure that I have my automatic contributions set up, and the rest takes care of itself. And I just want to give a shout out to Ramit Sethi. He wrote the book, I Will Teach You to Be Rich. And that is where I learned about the importance of these expense ratios. I probably missed out on a lot of like potential money because of not paying attention to that earlier on when I was investing, but it's never too late to make a change, and you can always educate yourself, learn more. I highly recommend that book as well, especially just for getting like the fundamentals of personal finance and like financial literacy. I will also link that book in the description below. And with that, let's move on to lesson number 3, which is do not try to time the stock market. Now, you've probably heard the terms buy low and sell high, right? And if we could just stick to that, then, well, it would be easy to time the stock market and we could all make money. But unfortunately, it's not that simple. Stocks are really high risk, but when you take into account the human psychology that goes into it, plus the high risk and volatility of the stock market, it can get a little crazy. You want to invest in the market, but when it comes to individual stocks, they are not sexy when they crash. You've got to take my word for it. I mean, I haven't lost a lot of money in this because I've always hedged my bets against going into individual stocks. I have never had more than like $3,000 in an individual stock trading account at any time in my life. And I'm not trying to tell you that you wouldn't be rich if you had invested in Apple before they blew up, or invested in Tesla, or invested in Nvidia, but we can't go back in time and we can't predict the future. If you're trying to time the market, you might as well just go into a casino, walk up to the roulette table, put it all on black, and see what happens. You never want to put enough money in the game that one bad stroke of luck could completely wipe you out of the game. And it can be fun and exciting to invest in stocks, but it is a gamble. And you have to know that if you're going for individual stocks, it is a gamble every single time. I'm just telling you what I would do and what I would not do. And I know that the risk and the odds are just not worth it for me to take any sum of money and put it into the stock market in the hopes that it might make me rich quick. It's just not worth it. It's so unlikely to happen. And the amount of money that you'd have to put in to get the kind of return that you're thinking is like nuts. I mean, I'll just give you an example. Okay, let's say a stock goes up 20%. That's really good, right? So what does that look like in real life? Well, if you put $100 in, then when it goes up 20%, you now have $120. Congratulations, you made 20 bucks. And that stock did really good. So for you to get rich, like if you want to turn $100 into $1,000, what percentage does it have to go up for you to get that? You see, like if you're going to make a large amount of money from that 20% gain, you have to put so much money in that now you could lose it all if it doesn't go up 20%. If it goes down 5% or down 20%, like to me, the risk is just not worth it. So that's my 2 cents. Do what you will with your money. Now, if you just listen to all that and you're still like, whatever, Woody, I'm going to go ahead and buy whatever stocks I want. Cool. Here is my recommendation though. If you're going to buy individual stocks, choose companies that you believe in and don't sell. Just hold that stock. And I say you need to believe in them because if you truly believe in this company, you are going to stay true to them even when they're down. Think of it like your favorite sports team. Even when they're having a bad season, you still root for them, right? You just want to buy the company that you believe in, even if they're having a downturn in the market, because when they're down, you put money in, you're buying shares on sale. And when they're up, you're paying more for shares, but all the shares you bought before have also gone up. If it's a company you truly believe in, I would hope that they are not going to go completely out of business. And there is certainly the possibility that that could happen to any company. So there is always risk. So take what I'm saying, not as advice, but just as information. But you are more likely to see a company like Apple or Tesla or Microsoft or Meta or Google, Alphabet, any of those, you are more likely to see those big companies go up over time. And so it makes more sense to choose companies you believe in and don't sell. Just hold on to it because you now own a part of that company. So why would you want to sell that if you believe in that company? Now let's start to bring this in. Number 2 is, what do we do with investing if we also have debt? So if you're sitting on debt and you're thinking about investing, there are a lot of considerations that go into this. I don't want to give you any cookie cutter example because not one piece of advice is going to work for everybody. It depends on your situation. It depends on what the numbers are, but I can give you some broad strokes of what have helped me when I've had debt in the past, but also wanted to look at investing. The first thing is to look at the numbers. And I'm talking, what is the total amount of debt that you have in different categories, right? So do you have credit card debt? Do you have a loan on your car? Do you have a mortgage on your house? Do you have other outstanding loans? So write down all of those amounts in those different categories, and then also pay attention to the interest rates and write those down as well. And if you have multiple credit cards, separate line items for each of those, but what are the interest rates on each of these cards? If you've got anything that is 15% to 30% interest, you have got to take care of that before you should really be looking at investing. And I would argue even less than 15%, like you should be considering trying to take care of that debt before getting into investing. But There is a way that you can do both at the same time as long as you come up with a plan and you actually stick to that plan. Now, one way you can handle that credit card debt is to do what is called a consolidation loan, and you might actually be able to take all of that debt and for a fee, get that into a consolidation loan that is one monthly payment that is a lower interest rate than the average interest rate of the credit cards. And just psychologically and practically, that one thing is a lot easier to chip away at than multiple credit cards, especially with the credit cards, you still have the ability to go and spend more money once you free up space on them. And that's a game that the credit cards play, that they're hoping that they win the game and you lose that game, that you keep spending and staying in debt so that they can keep charging you interest. With a consolidation loan, yeah, they're going to make some money off of you with that fee and with their interest rate, but it can be a lower interest rate overall. Now, if you want more information on where to go for a consolidation loan or the best way to approach that, that's another thing I could make a totally separate video about. And if you want me to make that video, once again, leave that comment below this video and I will make that video for you. Or if you're looking for a step-by-step guide on how to invest while tackling debt, that book I mentioned earlier, I Will Teach You to Be Rich, has the blueprint for how to do it with all of the caveats for different situations. So really, whatever situation you might be in, he has a method that is going to work and tells you exactly how much to pay towards each thing and how much to invest over here in order to maximize your lifetime returns and minimize the lifetime amount that you pay to other companies when it comes to fees. But my overall advice with that is come up with a plan and find a balance that you can actually stick with. The plan that you can stick with is the best plan, even if it is not hypothetically the best plan or theoretically the best plan. The one that you can stick with, the one that actually works, is the one that you should do. And with that, let's move into my number one tip about investing that I wish I knew before I started investing 20 years ago. But first, subscribe to the channel, hit like on the video if you've been getting value out of it. Now, tip number one, if you can't trade money for assets, trade time and other resources for assets. Now let's define what an asset is. But if you remember back at the beginning of the video, I said investing is all about acquiring assets that give you returns over time. Now you may have made the assumption that I meant that means putting money into things that gives you money over time. But there are other ways to gain assets other than just buying them. You can create assets. There are ways to do that. An asset is anything that is giving you something in return over time. And generally, yes, we're talking about it giving money over time. But if you don't have a lot of money to sink into assets right now, what are some other ways that you could get assets? So if another way to gain an asset is to create an asset, you need to do that with the resources that you have. So what are some of the resources that you have? Well, number one, you have your time and your energy. Number two, you have your knowledge and you have your experience. You have the things that you have lived and been through and the wisdom that comes with that experience. Number three, you have a phone or a computer, which you might argue, hey, not everybody has a phone or computer, but if you're watching this video, I'm willing to bet that you hopefully have at least one of those. And then number four, you have things that you could potentially borrow from other people, from friends or from family. Now, if you're wondering where I'm going with this, I want to talk about digital assets, things that can produce money for you over time, things that you create once and that either replicate themselves or are available over and over and over and over again without the need for you to trade more of your time. Digital assets are one of the ways that we can get away from having to trade our time for money. And there are all kinds of digital assets. You can have documents, you can have templates, you can have courses, you can have YouTube videos. So then the question becomes, well, what assets should I create? Should I do all of them? Not at first. You should probably pick one and stick with it for a long time. Sound familiar with the stocks we were talking about earlier? So then the question becomes, which one do I choose? Well, that depends on you and your skill set and your knowledge and your resources. But the best assets are the ones that create value for other people. They are the ones that are actually useful and actually helpful. And although you can probably use AI to assist you in making these assets, you can really go a lot farther with the value if it's more genuine and authentic and coming from within your own experience. People can tell when something was just spit out by a computer or whether it's coming from real human experience. Now, there are many ways to create digital assets, but I personally believe that YouTube is the best way for a number of reasons. First of all, every time you make a YouTube video, you are making evergreen content. What does that mean? It means it's not something that's going to disappear tomorrow or next week when the algorithm has a bunch of new stuff coming in. YouTube is unique because it is also the second largest search engine, with the first largest being Google, and Google shows YouTube videos in the results. So it's tied into the first largest one too. But when people are actually trying to solve a problem or gain some information about a new topic or make a buying decision, find some reviews, that kind of thing, they're going to Google and they're going to YouTube. They're plugging their questions into search engines. And what comes up? Videos. And these videos are assets. So when they go and watch those videos, those assets are generating views. And thanks to the ad revenue program that YouTube has set up, those views can be turned into money. Starting a YouTube channel is also a revenue stream that has been proven by millions of creators, but it's not just the ad revenue that you can earn from people watching your YouTube videos. It's also the potential to make money through affiliate links and sponsorships or selling your own stuff, either now or down the road. But every YouTube video that you create is this asset that also gains you subscribers and helps build this other asset called your audience. And if all of this sounds too far-fetched and you're like, I don't think I'm ever gonna have an audience, or I don't understand what any of this has to do with investing, trust me, because any way that you can make money now or down the road, any way that you can generate income through assets now or down the road is a form of investing. Now, I can talk about this more in future videos as well, but I do have a resource that is free for you. It's in the description. It is my free YouTube starter kit that comes in the form of 5 emails over 5 days. It doesn't cost a thing. There's nothing that I'm gonna try to upsell you to. I don't want your credit card or social security number or anything like that, but it is just a free resource. I actually made it for a friend and they said it was very useful, so I put it together as an email newsletter, 5 emails over 5 days. It's free for you. If you want it, pop down in the description and grab it now. Otherwise, I really hope you've liked this video. I'm gonna have another video right here for you as well, so go ahead and click on that and I'll see you in the next one.